Are you building a real estate business or just surviving deal to deal? If every project has you maxing out personal credit cards, begging lenders, and juggling bills like a circus act, that's not strategy. That's chaos. And I get it. When you're hustling, you do what you have to do just to get it done. But the top investors, they don't find deals, they engineer funding. If you want to grow without burning out, you need a capital stack. And in this video, I'm showing you how to build one step by step so you can scale fast, stay liquid, and move like a real pro. Let me break it down for you. When you're starting out, you might think, I'll just use my savings or take out a loan or get started. But that approach doesn't work if you grow beyond a handful of properties. Real estate investing is a marathon, not a sprint. Your deals are diverse, you're fixing flips, rentals, maybe commercial, or even wholesale deals. Each type has different capital needs and timelines. That's why you need to diversify your capital sources. Capital stacking, this means that you have multiple layers of funding, like a financial toolbox, so you can pull the right tool at the right time. Some capital is quick and flexible. This is good for fast moving deals. Some is longer term, which is perfect for building cash flowing assets. Some is inexpensive. Others, they're more costly, but they have speed and convenience attached to them. This strategy helps you avoid the common trap of relying on just one money source, which can leave you stuck if you're over leveraged or overexposed. You're at a personal risk. I mean, think of it like this. Would you try to build a skyscraper with only bricks? No, you would need steel beams, concrete, wiring, plumbing, layers working together, which is your capital stack, your financial infrastructure. Today, I'm breaking down the 5 types of capital every smart real estate investor should have in their toolbox. That's if they want to build solid infrastructure and scale confidently. Let's start with the most familiar and accessible source, personal credit. This includes your personal credit cards, home equity lines, personal loans, and even your own cash reserves. Personal credit is the foundation for many investors starting out. It's fast, it's flexible, and it's your own financial reputation backing it. But there's a big catch. It's limited and it's risky if you lean into it too heavily. Your personal credit score doesn't just open doors for you. It's also a gatekeeper for business credit and some types of financing. So you want to keep it healthy and not max it out. Use personal credit strategically for setup and bridge capital. For example, you might use a personal credit card to pay for like earnest money, deposits, or inspection fees, things you can get done quickly, and take out a small personal loan to cover a short-term repair while securing a longer-term loan. But here's where many new investors go wrong. They treat personal credit like a business credit card and a permanent source of capital. This leads to maxing out personal credit cards, taking high interest loans. This puts your personal finances and your credit score at risk. If your credit takes a hit, you won't just hurt your ability to invest. You'll hurt your car loans, mortgage options, and everything else that has anything to do with your finances. So think of personal credit as your starter fuel. Useful, but don't build your entire portfolio on it. Use it to get deals going, but then transition it to business credit and other capital sources as soon as you can. Next, we step into business credit cards. This is where things start to get interesting for investors, especially if they're looking to scale beyond 1 or 2 deals. Business credit cards come with a number of perks. A lot of them are invaluable. For starters, many of them have introductory periods of 0% interest from 12 to 18 months. That means you can finance your business expenses interest-free if you pay the balance off within that window. Use business credit cards to fund marketing campaigns, pay for materials, cover soft costs such as permits, inspections, or even software subscriptions that you might use. These are expenses that keep your deals moving forward, but don't require you to tap into your personal funds. Another huge benefit in business credit cards, typically, they don't report to your personal credit bureaus. This means your personal credit can remain intact and protected. This separation is crucial to building a strong business credit profile and to keeping your personal credit clean. Plus, many business credit cards offer rewards, cashback, travel points, discounts on business services, which can help you reduce the overall cost of business expenses. I mean, I've only paid for a couple of my flights this year, and it's all because of business credit cards. Now, you do need to have your business properly set up to qualify for these cards. That means forming an LLC or corporation, obtaining an EIN, and having a business bank account. This is the bare minimum. If you haven't started building business credit yet, this is one of the easiest, most effective ways to get started. And it's a major step in scaling your funding without risking your personal credit. Now we get into the serious stuff: business credit lines. These are revolving lines of credit tied to your business, kind of like a giant business credit card, but with higher limits, better terms. Business lines of credit provide flexibility, revolving access to cash that allow you to borrow when you need it, pay it back, then borrow it again. This flexibility is perfect for rehabs, gap funding, or handling unexpected finances. To qualify, you'll need your business properly structured, a LLC or corporation. You hear me say this over and over again. Make sure you have an EIN and a bank account with solid business banking credit history. Lenders want to see revenue history, past performance, but many lines are unsecured based on your credit and your business profile. This type of credit is often cheaper than hard money loans or credit cards with better interest rates and longer repayment terms. Let's use this example. Imagine you find a deal that needs $50,000 in rehab funds. Instead of pulling from personal savings or high interest loans, you draw on your business line, and then you just repay it once you sell or refinance. Business credit lines increase your purchasing power and your credibility. Vendors, contractors, and even future lenders see you as serious, professional, and a top-tier investor. This is going to open up deals to better terms. So if you want to scale beyond hobby investing, building, and managing a business credit line, this is a must. Next up, private lenders. This is where relationships meet capital. Private lenders, they're individuals or groups who lend money based on your deal's merits and your relationship, not just your credit score. They might be friends, family, real estate investors, or professionals like doctors and lawyers who want to earn a solid return without managing properties. Private lending is a game changer because you're not dealing with rigid bank rules or slow approvals, but structure is a key. Typically, private lender deals are 12-month loans with a fixed interest rate, collateral on the property, and clear terms. The best private lenders want to see a professional loan package, your business plan, projected returns, an exit strategy, and a track record. When you build trust and professionalism, private lenders, they become repeat, reliable sources of capital. Many investors start with one private lender and grow to a network that funds their deals at scale. So, unlike hard money lenders, private lenders, they often offer more flexible terms. They usually have like a lower interest rate and the faster closing, but the real power is the relationships. Treat them right, communicate clearly and properly, and deliver results. They're going to be your best friend. Private lenders, they are crucial to your capital stack, and it's key to a sustainable business growth. Finally, working capital loans or revenue-based financing. These are loans that are tied to your business's cash flow or your business's revenue rather than just your credit or collateral. They offer quick access to capital with faster approval times, and it's something usually like 24 to 72 hours, which is perfect when you need to move fast. You use working capital loans to cover flips, fill cash flow gaps, like when you're in between deals or you need to manage overhead and expenses while you're waiting on rents or sales proceeds to come in. Because these loans are higher risk for lenders, they usually come with a pretty high interest rate, or sometimes even with fees. But with speed and flexibility, often it makes it worth it. Think of working capital as a short-term fuel to keep your business moving forward. And this is without any pauses, so it makes it worth it. The key in this is to use it strategically. You cannot rely on this as your main source of funding. They're perfect for smoothing out the bumps, seizing last-minute opportunities, or just covering expenses that traditional lenders won't touch quickly. If your business is growing steadily and you have a reliable revenue stream, working capital loans, they can be an important tool just to maintain the momentum. So here's the bottom line. Capital isn't just money, it's control. Control over your deals, control over your timing, and ultimately control over your financial future. When you build a layered capital stack, combining personal credit, business credit, private lenders, and working capital loans, you create flexibility, security, and freedom to scale your portfolio smartly and sustainably. To help you take action, I've created a free downloadable capital stack blueprint. This is going to break down exactly how to build and manage these layers, step by step. And I've got something special for you. I've opened a private space exclusively for real estate investors who want to stay ahead of the market shifts, get insider level funding strategies, and learn real world game plans. I usually reserve for high ticket clients, but if you're serious about growing your real estate portfolio, this is where you belong. Plus, if you're ready to map out exactly how to fund your next move, my team is opening up time to speak with you directly. No guesswork, just customized funding solutions based on where you are and where you're headed. Go ahead and click the link below, get plugged into the cash flow department, and lock in your appointment while spots are still open. Until then, I'm Mo the Closer, and I'll see you at the bank.